Welcome everyone to Vested Interest. This is Shane back for our weekly portfolio update video. We do these every Sunday morning at 7:30 a.m. On this one, we will take a look at all the activity in the portfolio just like we do every Sunday. We did add $2,305 to the portfolio, so we'll look at what those funds purchased. But before we get in the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and to like the videos, and a special thank you to those who've subscribed to the channel. I really do appreciate it. For those of you who may be stopping by for the first time, on this channel we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing dollar cost average into the portfolio on a weekly basis. You pick your time to invest. It could be weekly, bi-weekly, once a month, once a quarter, once a year, whenever you get your taxes back. But make sure you are consistent. I focus on buying dividend growth stocks and growing companies with positive cash flow that covers the dividend with a high return on their invested capital. Again, I invest in the portfolio on a weekly basis, and I'm going to show you exactly what's going on in the portfolio. On this channel, there's nothing to pay for. We do not have a paid Patreon account. I don't have any paid paywalls. You don't have to send me any money to see what we're doing. I'm not going to send you to another site that you've got to sign up for or give me your email address or any of that stuff. It's free to see what I'm doing, but if you would like to help out the channel, if you could take a moment, hit that thumbs up button down below, hit the subscribe button, join us on this journey to financial freedom, join the vested interest community, hit that notification bell so you're notified whenever we put out any new content. Doing that really does help out a small YouTube channel like mine with the YouTube algorithm. Really appreciate everyone who's taken the time to do that. And share with anyone you think that might find value, and drop a comment down below. Let me know what you are buying in your portfolio right now. I think there's a lot of potential buys out there right now. A lot of companies have really pulled back that are good companies that are presenting some value. So hopefully you are taking advantage. Now let's jump into the video and see what's going on with the portfolio this week. So we typically start out with options. The last couple weeks I have not done very well with options. I have not gotten any bites on the options. I am being a little bit conservative, which I don't mind. I don't like when positions are called away and I have to add additional funds, which happened to one of the positions out of the two calls I did previously. So I backed off and have gone a little bit more conservative, but it also has cost me some potential plays here as well. So we're going to keep throwing out hooks and see what bites we can get, but nothing for this week to report. And nothing for dividends to report. One of the few weeks in the portfolio, no dividends came in. So pretty quickly ran through the options portions and the dividends portion. So we will get into the new capital. And finally, on May 6th, we did add $1,743.95. With those funds, we picked up 10 shares of Enterprise Product Partners, ticker EPD. Picked up those shares at $28.20. This is a energy company out of the oil and gas company. They are really an oil and gas line distributor, so they are shipping the oil and gas through their pipelines. Picked up those shares at $28.20 out of the energy sector. Picked up 6 shares of Pfizer, ticker PFE, out of the healthcare sector. Picked up those shares at $28.06. 10 more shares of Starbucks, ticker SBUX. Picked up those shares at $73.55 per share. This is one I'm really building out right now. Newest position in the portfolio, so I'm trying to get it to 100 shares before it really rebounds. I think by the end of the week it was actually up to $76, so it already has rebounded a little bit. But I'll probably continue to add as long as it's under my cost basis and really under about $80 per share. So as long as it remains there, we're going to continue to add. CVS really took a big pullback, so we added 10 more shares there. Ticker CVS, out of the healthcare sector, much like Pfizer. The healthcare sector in general has really pulled back right now. Johnson & Johnson, Bristol Myers Squibb, CVS. A lot of companies in the healthcare sector have really pulled back, so we took advantage. 10 more shares at $55.81. The $1,743.95 in all the shares that we picked up added $80.08 in additional passive income over the next calendar year. And we weren't done. We went back into the portfolio and added another $561.61 on May 10th. And on May 10th, with those funds, we picked up 3 shares of Sibanye-Stillwater, ticker SBSW. This is a mining company out of the material sector. Picked up those shares at $5.04 per share. Vale, ticker VALE, we picked up 8 more shares there. Another mining company out of the material sector. Picked up those shares at $12.47. Realty Income, this is one that I've been adding here pretty regularly. As long as it stays under my cost basis, I probably will. Might not add every week, but maybe every other, a couple shares here. We picked up 2 more shares of the monthly paying REIT at $54.89. I think my cost basis is in the $58 range, so I'm going to continue to nibble on it as long as it remains below my cost basis. And the next two ETFs, these are ones we are picking up at least one share of these ETFs every week, at least through this year. We will probably continue on into the future, but we picked up one share of VTI. This is the Vanguard Total Stock Market ETF, and it's exactly what it says. Every company in the United States stock market is in this ETF. We picked up that one share at $257.75, and we're going to pick these up no matter what the price is in the market. That's actually the highest I think we've paid for it so far. But so hopefully it pulls back, but if it doesn't, we're going to continue to buy. And same thing with SCHD, another ETF. This is the Dividend Growth ETF from Schwab. Picked up that one share at $79.25. And the $561.61 and the new shares it picked up added an additional $22.46 in passive income. So total invested $2,305.56, which added an additional $102.54. And these are two back-to-back weeks. We've had over $100 added to the portfolio. Really like to see that. So the snowball is really growing well with the new capital we are allocating to the portfolio here, as well as weeks we have dividends that pay out, and as companies raise their dividends, which we've seen several companies do over the last couple weeks as well. Now on to the sector breakdowns here. Going to take a look at the overall portfolio by sector. Communications makes up 9.76% of the portfolio. Consumer discretionary at 5.66%. Consumer staples makes up 10.24%. Energy at 6.05%. Financials makes up 6.12% of the portfolio. Healthcare sitting at 13.58%. Industrials at 6.98%. Technology makes up 6.76%. Materials 11.07%. Utilities at 10.34% of the portfolio. REITs and real estate at 10.86%. And still the smallest slice here, ETFs makes up 2.58% of the portfolio. And over here to the right, it's the same information, just broken down a little differently. You can see the percentages here, but then also the monetary value of each sector as well, how much in funds I have in each sector as well. Now, what a lot of you like to see every week, and I'm going to show it every week, whether the market's up, whether the market's down, whether the market's floating sideways, I'm going to show you my portfolio every week. Hopefully this gives some of you out there who have not started your portfolio, being able to see a real portfolio built out over time and the ups and downs involved with building out a portfolio, gives you some confidence to start your own portfolio and realize that, you might start a portfolio and you might go down a little bit. You might start a portfolio and go up. You're going to have ups and downs in the market. It's perfectly normal. You can see the red, right? Those red blotches, that means I'm down on positions. And the green, that means I'm up on positions. So even within your own portfolio, if you have individual stocks, you'll probably have some that are doing well. You'll have others that are doing bad, and they will shift over time. That is part of the market. So that's why I want to show my portfolio every week so you can see that it's part of the market. Now you can see here in this row here, this column here, all of the different positions, how many shares of each I own, the current price as of the close of business on Friday, market value as of the close of business on Friday, my average cost per share in this column here, my purchase price, so how much I have into each position here, this is what the market value is, whether I'm up or down, total return here, right? Again, if you're seeing red, that means I'm down. Percent total return here, same thing. If you're seeing red, that means those are positions I'm down in. What sector the positions fall in, whether they're a quarterly, monthly, semi-annual payer, and the highlighted cells are companies that have already raised their dividends this year. Current yield as of the close of business on Friday, my yield on cost, portfolio weighting. The previous page we saw the sector weightings. This gives you each position's weighting. I don't like any one position to be more than 10% of the portfolio, and I don't like any one sector to be more than 20 to 25% of the portfolio. It really depends. If one particular sector was to run up, it doesn't mean I'm just going to start selling out of positions because it's over 25%. It would just mean, or one position was to run up and made it more than 10%. It doesn't mean I'm going to sell it. It just means that I'm going to back off adding to it. Estimated annual income, payout months, the dividend growth year over year, and where the company sits at 15% of its 52-week low. So let's talk about this a little bit. I use this as a high gauge. This number right here, I don't want my average cost per share to be higher than where it sits at 15% of its 52-week low. The lower, the better, actually. The cheaper I can get shares, the better. So if you look at BABA, for example, I was building out this position. I'm now over 100 shares. I have 108 shares. My cost basis is $75.44. So I'd like to add to this position, but I want it to be under my cost basis or with where it sits within 50% of its 52-week low. So I could add to if it was in the $76, let's say it was $76.50. I could add to it. That's under where it sits at 15% of its 52-week low, even though it's over my cost basis, right? So this just gives me a high water mark of where I'm willing to pay for it. And I could even go a little bit above that as long as it didn't pull my average cost per share over this number. Hopefully that makes sense, and I'm explaining it in a way that you can understand it. But that's what that column is for. Total shares, I'm sitting on 6,593.471 shares. Market value of $252,309.28. I have $240,019.86 into the portfolio. That's my money out of my pocket. It is up $12,289.42, up 5.12%. I do not focus on this. You'll notice whenever I was down, I was saying the same thing. Now that I'm up, I'm saying the same thing. I do not focus on whether I'm up or down on the overall portfolio. I just don't. That's not what I'm focused on. Over here, that's circled. That's what I focus on. Current dividend yield is 4.292%. My yield on cost is 4.512%. And this column right here, estimated annual income, is what I'm focused on. All of the dividends, all the annual income provided by the positions in the portfolio continues to grow week to week, month to month, quarter to quarter, year over year as I add new capital, as the positions in the portfolio raise their dividends, as they pay out dividends and buy more shares, right? Because whenever we get dividends, those shares go right back in and buy more shares of the same company. And as we add new capital, like you saw me add this week. Sets a new record this week, $10,829.14. We are very close. I would say over the next 2 trading weeks, we're going to be over the 11,000 per year mark. It's getting very close. I would not be surprised, like I said, probably not next week, but the week after, we are over that and then on to 12,000. And the dividend growth here sits at 5.86% year over year. And that's that's basically this number here averaged out. As these companies increase their dividends, it should be about 5.86% increase, even if I was to stop adding new capital. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hopefully, you started your own investing journey as well. And if you have not, drop a comment down below and let me know what you're waiting on. What is the holdup? Why are you not securing your future by investing? And it doesn't have to necessarily be dividend growth investing. You could be an ETF investor. You could be a growth investor. You could be investing in small caps, in large caps, in mid caps, whatever you're looking to invest in. I would just say that you should be buying equities. You should be buying shares of stocks that are growing over time so that you can grow your income over time. And eventually, the goal would be to get to financial freedom and live off of in my case, the passive income, the dividends provided by the portfolio. Maybe you're using the 4% rule where you're buying equities and eventually you plan on selling them off. Really, I don't care which way you're doing it, what strategy you are using. Just make sure you start as young as possible. Be consistent. You're going to learn things along the way, right? Sometimes the best way to learn is to get your money in the market, and sometimes you're going to pay a hefty fee for that learning, but it's no different than going to college or any other courses or tests you might take. Or classes you might take. I mean, they're going to cost you some money. So investing in the market probably will a little bit. There are no perfect investors. Even the greatest investors in the world have lost money on plays that went wrong. So don't let that be a reason to deter you from starting your investing journey. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So drop a comment down below. Let me know what you're adding to your portfolio this week. What do you have your eyes on? What are you waiting for more of a pullback on? Would love to hear from you. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we will see you in the next one. Hey, I'm not a financial advisor. You should be doing your own due diligence. You can read this disclaimer. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing for educational and entertainment purposes. Go ahead and read the rest. Investing does involve risk. Know what you're doing. Don't just blindly copy someone on YouTube. Hey, have a good weekend. Take care.